UBS Silver Fund reevaluated. Amidst market sell-off, one morning, a fund worth millions didn't just drop, it was revalued. Investors couldn't exit, trading froze. And then a compensation plan appeared, just like that. No warning, no explanation, just a new number. Was this a system doing exactly what it was designed to do? Or was this something else entirely? Because the difference between those two answers could change everything you thought you knew about where your money actually sits. Welcome to Metal and Macro. Now, before we go any further, if you found your way here today, you probably didn't stumble in by accident, so do something your younger self would have done without hesitating. Hit that subscribe button. Think of it like locking your front door at night. Simple habit, quiet protection. You'll be glad you did. And while you're here, drop a comment below and tell us which city, which country, which corner of this world are you watching from today? We rate every single one. Now, let's get into the story. It began like most financial shocks do, quietly, no sirens, no emergency broadcast, no warning bell ringing across trading floors, just a number that suddenly didn't make sense anymore. One morning, investors who had placed their trust and their capital into a major silver-linked fund woke up to something they did not expect. The UBS Silver Fund, a product that many had considered a relatively stable way to gain exposure to silver markets, had been reevaluated, and that reevaluation did not go in their favor. The fund dropped by just over 30%. Not because silver itself collapsed overnight, not because some catastrophic global event wiped out commodity markets in a single session, but because of something far quieter, and in many ways, far more unsettling. A valuation method had changed. To understand why that matters, one must first understand who was in this fund and why they were there in the first place. Silver has long held a unique position in the world of commodities. It sits at the crossroads of industrial demand and precious metal appeal. When global uncertainty rises, investors move toward metals. When manufacturing expands, silver follows that growth too. It is, in the eyes of many serious investors, a dual-purpose asset, part safety net, part growth play. So when UBS offered a structured fund tied to silver futures, it attracted a specific kind of investor, not reckless speculators, not overnight gamblers. These were people who believed they were making a calculated, structured decision. People who read the product description, noted the open-ended nature of the fund, and assumed that meant flexibility, assumed it meant liquidity, assumed it meant control. They were about to learn that assumptions in financial markets carry a very high price. The sell-off that preceded the revaluation did not appear from nowhere. Markets across the globe had been experiencing pressure. Metals were moving sharply. Volatility, which had been building beneath the surface for weeks, was beginning to show itself openly. Traders who watched these things closely had already noted the tension in commodity markets, the kind of slow tightening that precedes a sudden snap. And then it snapped. In the region where this fund operated, silver futures were hitting their daily move limits. These are boundaries built into certain markets, hard ceilings and floors designed to prevent extreme single-session crashes. When a futures contract hits that limit, trading in that contract effectively locks. It cannot move further in that direction for that session. On the surface, that sounds protective, sensible even, like a circuit breaker in an electrical system, designed to prevent a fire from spreading. But here is what most people in the fund did not realize in that moment. While the local futures market was locked, the global silver market kept moving. London was pricing silver one way, New York had its own red, and the locked local futures contract was sitting frozen, increasingly disconnected from the real-time global price of the very metal it was supposed to track. Two prices, same asset, and a fund caught directly in the middle. When the fund's managers applied the updated valuation method, one that more accurately reflected where silver was actually trading globally, the gap between the old number and the new number was enormous. And that gap landed entirely on the investors holding the fund. 30% gone. Not from a market crash, not from a failed business or a bankrupt counterparty, but from a recalculation. Trading in the fund was halted. Investors who tried to exit found the doors closed, phones rang, emails were sent. Complaints flooded in from individuals who could not understand how a product they believed was open and liquid had suddenly become impossible to leave. And then, almost as quickly as the chaos erupted, something unusual appeared. A compensation plan, announced, structured, ready to deploy, which raised a question that no official statement bothered to answer directly. If this was truly an unexpected market event, why was the compensation plan already prepared? Most people, when they hear the word revaluation, think of loss. They think of a number going down, they think of money disappearing, they think of someone somewhere making a decision that cost them something they worked hard to build. And sometimes they are right. But sometimes revaluation is nothing more than a plumbing issue, a pipe that needed adjusting, a pressure valve doing exactly what pressure valves are supposed to do. The problem is that most investors, even experienced ones, cannot tell the difference between the two until it is far too late. That gap in understanding is exactly where this story lives. To truly grasp what happened inside the UBS Silver Fund, one must first step back from the drama of the headlines and enter a place most people find deeply uncomfortable: the mechanics. Because markets do not run on emotion, they run on structure. And when that structure bends under pressure, the resulting crack looks almost identical, whether it was caused by negligence or by design. So here is how this particular structure was built, and precisely where it broke. An open-ended fund, by its very nature, is built on a promise. That promise is simple. Investors can come in, investors can leave, and the price at which they do either of those things should closely reflect the real value of what the fund holds. That sounds reasonable. That sounds fair. And under normal market conditions, it largely works. But embedded inside that promise are three separate numbers. And when those three numbers stop agreeing with each other, the promise begins to crack. The first number is the live trading price of the fund shares themselves, what buyers and sellers are willing to exchange them for on the open market at any given moment. The second number is the price of the underlying silver futures contract that the fund is directly tied to, the local futures price, governed by the rules and limits of the exchange where it trades. The third number is the fund's published net asset value, the official calculated figure that represents what the fund's holdings are theoretically worth on paper. Under calm conditions, these three numbers stay close to each other. They move together like three people walking in step. But the moment market stress arrives, they begin to drift. And once they drift far enough apart, the entire foundation of the product becomes unstable. Now, here is where the mechanics of this specific event become critically important to understand. The silver futures market in the region where this fund operated uses a daily price movement limit. This is not unusual. Many Asian commodity exchanges employ similar mechanisms. The logic is straightforward: prevent panic-driven crashes from becoming catastrophic within a single trading session. When silver began falling sharply, the local futures contract hit that limit. It could not print a lower price. Trading in that contract locked. But silver did not stop falling. In London, silver kept sliding. In global spot markets, the metal continued its descent. The world price of silver was moving in real time, while the local futures contract was frozen, displaying a price that no longer reflected reality. This created something deeply dangerous inside the fund's structure. The fund's managers were now holding a product whose reference price had become fictional. The local futures said one thing, the global market said something entirely different. And sitting between those two contradictory realities were thousands of investors, completely unaware that the number they were looking at no longer meant what they thought it meant. When the decision was made to apply a valuation method that reflected global silver pricing rather than the frozen local futures price, the gap closed instantly, 30% in a single adjustment. Now here's the question that separates a sophisticated investor from everyone else in the room. Was that revaluation wrong? Technically, no. If anything, it was arguably the more honest number. The previous valuation had been quietly overstating the fund's real-world worth for as long as the local futures had been disconnected from global prices. The revaluation did not create the loss. It simply revealed it. And that distinction is everything, because it means the damage was already done long before that morning. It was already sitting inside the structure, invisible to most, accumulating quietly like pressure behind a sealed door. The revaluation was not the moment the fund broke. It was the moment someone finally opened the door. But here's where the story refuses to stay simple. If the revaluation was technically justifiable, why did trading halt immediately after? Why were investors blocked from exiting at precisely the moment they needed liquidity most? And why, of all things, did a fully structured compensation plan surface within hours of the announcement? Plumbing issues do not come with pre-written settlement agreements. Structural corrections do not arrive with ready-made payout schedules. Those things take time to prepare. They require legal review. They require approval at multiple levels of an organization, unless they were prepared in advance. And if they were prepared in advance, then someone already knew this door was going to open. There's a moment in every financial crisis that historians later call the signal. Not the crash itself, not the headline, not the emergency meeting or the compensation plan or the frozen trading screen. Something quieter than all of that. Something that was visible, if you knew exactly where to look, long before the doors closed and the numbers stopped making sense. The UBS Silver Fund event was not the crisis. It was the signal. And understanding what it is signaling may be the most important thing a serious investor does this year. History has a very uncomfortable habit of repeating itself. Not perfectly. Not with the same names, the same funds, or the same headlines, but with the same architecture, the same structural logic, the same sequence of events dressed in different clothing, playing out in different markets in different decades, but following an almost identical script. Those who have studied market history long enough begin to recognize that script the moment it starts. And this one has been performed before. Cast the mind back to 2006. A natural gas fund in the United States, managed by a trader named Brian Hunter under the Amaranth Advisors umbrella, collapsed spectacularly. Not because natural gas became worthless, not because the global energy market disintegrated overnight, but because the fund's internal pricing mechanisms became dangerously disconnected from real-world market conditions. Position sizes grew too large for the underlying market to absorb. And when pressure finally arrived, the structure could not hold. $6 billion, dissolved in a matter of days. The mechanics were different from the UBS Silver Fund. The asset was different. The geography was different. But the fingerprint was identical. A structured product tied to a commodity futures market that quietly accumulated a dangerous gap between its internal reality and external market truth, until that gap could no longer be ignored. Then cast the mind further back. 1993. Metallgesellschaft, a German industrial giant, constructed an elaborate oil futures hedging program. The logic was sound on paper. The execution was technically sophisticated, but the strategy required constant liquidity in the futures market to function correctly. When oil prices moved against their position and margin calls began arriving, the liquidity they assumed would always be there simply was not. Nearly $1.5 billion lost, not from a bad bet on oil's direction, from a structural assumption about market liquidity that proved catastrophically wrong under pressure. The pattern is not coincidence. It is architecture. Now return to the present. Return to the UBS Silver Fund. And look not at what happened, but at what it reveals about the broader landscape that surrounds it. The first implication is one that most financial media will not say clearly, so it must be stated here without softening. Open-ended fund structures tied to futures markets carry a hidden fragility that only becomes visible under stress. Under calm conditions, these products function elegantly. Creation and redemption mechanisms keep prices aligned. Liquidity appears abundant. Investors move in and out with confidence. The architecture looks solid from every angle. But that architecture contains a fundamental assumption that the underlying futures market will remain liquid and functional at precisely the moment investors need to act. That assumption holds right up until the moment it does not. And when it fails completely. There is no partial failure in these structures. There is no gentle correction. There is a halt, a gap, and a number that leaves investors with no exit and no warning. This is not a flaw unique to the UBS Silver Fund. This is a structural reality embedded in dozens of similarly constructed products currently operating across global markets. The question is not whether this will happen again. The question is where it will happen next. The second implication runs deeper still, and it concerns the relationship between local market rules and global commodity pricing. Every major commodity, silver, gold, copper, crude oil, trades across multiple exchanges simultaneously. London, New York, Shanghai, Singapore. Each exchange operates under its own rule set, its own circuit breakers, its own daily move limits, and when those local rules collide with the reality of a globally priced asset moving freely across other markets, the gap that emerges is not a glitch. It is a structural fault line. The UBS Silver Fund fell directly into that fault line. The local futures market locked. The global silver price did not. And the fund sat precisely at the intersection of those two realities with no mechanism to reconcile them gracefully under pressure. This fault line exists in other markets. It exists in other funds. It exists in other geographies where locally regulated futures products are tied to globally priced underlying assets. And every single day that markets remain calm, that fault line remains invisible, comfortable, easy to forget, until it is not. The third implication is perhaps the most sobering of all, and it concerns investor understanding. The individuals who lost 30% inside the UBS Silver Fund were not, by and large, uninformed people. They were not reckless. They had read product descriptions. They had noted the open-ended structure. They had made what they believed was a reasoned, informed decision to hold a silver-linked instrument through a period of market uncertainty. What they had not done, what almost no retail or semi-institutional investor does, is read the mechanics underneath the product description. The valuation methodology, the specific futures contracts used as reference prices, the daily move limits of the underlying exchange, the precise conditions under which redemptions could be suspended. That information existed. It was documented. It was technically available, but it was written in the language of structure, not the language of risk. And that gap between what is technically disclosed and what is genuinely understood is where 30% of someone as capital can disappear on an ordinary morning without a single rule being broken. Markets do not warn you with sirens. They warn you with structure. And right now, the structure of commodity-linked funds globally is sending a message that very few people are pausing long enough to hear. The UBS Silver Fund did not fail in isolation. It cracked along a fault line that runs through the entire architecture of how futures-linked products are built, sold, and understood by the people who hold them. That fault line did not close when trading resumed. It did not disappear when the compensation plan was announced. It is still there, waiting for the next moment of pressure, waiting for the next morning when a number stops making sense. And somewhere, right now, in a portfolio that belongs to someone who believes they made a careful, informed decision, that morning is already being scheduled. There is a particular kind of silence that follows a financial shock. Not the silence of resolution, not the silence of recovery, but the silence of people, sitting very still, staring at a number on a screen, trying to understand how something they trusted became something that hurt them. That silence is not weakness. That silence is the beginning of wisdom, but only if it is followed by the right questions, asked in the right order, with the discipline to act on the answers, regardless of how uncomfortable those answers turn out to be. Because markets do not reward emotion. They do not compensate loyalty. They do not care how long someone held a position, how carefully they read a brochure, or how reasonable their assumptions seemed at the time of purchase. Markets reward preparation, and preparation begins right now. The first and most immediate task for any serious investor following the UBS Silver Fund event is one that most people will delay because it is uncomfortable. A full structural audit of every commodity-linked product currently sitting in their portfolio. Not a surface review, not a quick glance at performance numbers or a reassuring conversation with a fund representative. A genuine line-by-line examination of exactly how each product is structured, what futures contracts it references, which exchange those contracts trade on, what daily move limits govern that exchange, and critically, under precisely what conditions redemptions can be suspended or valuations adjusted without prior investor notification. This is not a complex process, but it requires something most investors genuinely resist: the willingness to read the documentation that was always available, but never felt urgent enough to examine closely. The UBS Silver Fund event made it urgent. Every open-ended fund tied to commodity futures deserves that examination now, not next quarter, not after the next earnings report, now. Because the fault line identified in part 3 of this analysis does not announce itself before it cracks. It simply cracks. And the investors who conducted their audit before that morning are the ones who exit cleanly. The investors who conducted it after are the ones filing complaints and waiting for compensation plans. The second strategic response concerns the framework of questions that every serious investor must now bring to every structured product conversation going forward. There are 5 questions that cut through product descriptions, past marketing language, and beyond the comfort of open-ended labels, directly into the structural reality underneath. First, what is the exact reference price this fund uses for valuation, and which exchange produces that price? Second, does that exchange operate daily move limits? And if so, what happens to the fund's valuation methodology when those limits are triggered? Third, under what specific conditions can investor redemptions be halted, and who holds the authority to make that decision? Fourth, how wide is the permissible gap between the fund's published net asset value and the live trading price of its shares before a mandatory revaluation is triggered? Fifth, has this fund ever suspended redemptions before? Under what circumstances? And how was that event resolved? These are not aggressive questions. They are not accusatory. They are the baseline questions that a serious, informed investor asks before committing capital to any structured product in today's market environment. Any fund manager, advisor, or product representative who cannot answer them clearly has already answered the most important question of all. The third strategic consideration moves beyond individual portfolio management and into the broader question of how serious investors position themselves in precious metals during periods of structural uncertainty. The UBS Silver Fund event did not diminish silver as an asset. Silver's fundamental characteristics, its industrial utility, its monetary history, its position as a globally recognized store of value, remain entirely intact. What the event damaged was not silver itself, but one particular method of accessing silver through a structured intermediary product. And that distinction carries enormous strategic weight, because there is a meaningful difference between owning silver and owning a product that owns a futures contract that references silver. That difference, under calm conditions, may appear trivial. Returns track closely. Liquidity feels identical. The experience of holding either seems roughly equivalent, but under stress, the difference becomes a canyon. Direct ownership of physical silver, held in allocated, audited, insured storage, does not halt redemptions. It does not apply new valuation methodologies at inconvenient moments. It does not contain a clause buried 40 pages into a product prospectus that permits a 30% adjustment without prior notice. It simply exists at whatever price the global market assigns to it, available whenever its owner chooses to act. This does not mean structured products have no place in a sophisticated portfolio. They do. But the UBS Silver Fund event serves as a precise and timely reminder that every layer of structure inserted between an investor and the underlying asset is a layer of risk that does not appear on any performance chart until the moment it matters most. Serious investors in the aftermath of this event are quietly reassessing that layering. They are asking how much of their metals exposure lives inside structures and how much lives in the asset itself, and they are adjusting that balance with calm, deliberate intention. The fourth and final strategic consideration concerns something that the compensation plan itself revealed, whether intentionally or not. Fund governance is not a secondary concern. It is a primary one. When a compensation plan surfaces within hours of a major revaluation event, fully structured, legally reviewed, ready for deployment, it tells a sophisticated observer something very specific. It tells them that somewhere inside that organization, someone had already modeled this scenario, had already calculated the exposure, had already drafted the response. That level of preparation is not inherently sinister. Large financial institutions maintain contingency documentation for dozens of scenarios simultaneously. That is responsible risk management at an institutional level. But it raises a governance question that every investor in every structured product should be asking about the organizations managing their capital. What scenarios has this institution already modeled that they have not yet told me about? What stress tests have been run internally? What fault lines have already been identified within their own risk framework? What compensation plans, restructuring documents, or contingency protocols exist in folders that investors will only discover on the morning they are needed? This is not paranoia. This is governance literacy. And it is the single most undervalued skill in the toolkit of the modern investor. The organizations that manage serious capital are not operating blindly. They have visibility into structural risks that their clients do not. The gap between what institutions know about their own products and what investors understand about those same products is where financial shocks live. Closing that gap through direct questions, through independent research, through genuine structural understanding is not the responsibility of the fund manager. It is the responsibility of the investor. The UBS Silver Fund event will eventually fade from headlines. The compensation plan will be processed. Trading will resume, and the broader market will move on to the next story, the next shock, the next morning when a number stops making sense. But the fault line that this event exposed will not fade with the headlines. It will remain, embedded in the architecture of similar products, waiting in the mechanics of other funds, sitting quietly beneath the surface of portfolios held by investors who have not yet asked the right questions or conducted the audit that this moment demands. The market has issued a warning, not with sirens, not with emergency broadcasts, not with flashing red numbers across a trading terminal, but with something far more precise, with a fund that was revalued on an ordinary morning, during an ordinary sell-off, in a way that was technically justifiable, structurally explainable, and financially devastating. That is how markets speak to those who are paying attention. The only question that remains is whether you are listening